With the uncertain global economic condition in recent times, it is quite imperative for individuals to understand how to build diversified portfolio for wealth in the long run. The word diversification is a term that is frequently used in the investment world, which implies investing in a range of assets to reduce exposure to risk. Diversification aligns perfectly with this idiom that says, do not put all your eggs in one basket, which implies that as an investor you need to be tactical in your investment decisions so as not to have all your investment in a class of asset. By investing in a range of assets, in contrast to a single asset, you will be able to minimize your overall risk as the risk is spread over your assets, because if any of the assets is exposed to high risk, thus affecting your return, you will be able to leverage on the benefits from other investment assets. I will be highlighting 8 investment classes that you can start investing in and build your wealth around them. Another interesting thing about these assets is that some of the richest people in the world invest profusely in some if not all of these assets. 1. Real estate. By real estate, it means income-generating real estate such as lands, offices, multi-family residential dwellings, retail and industrial properties, and hotels. Therefore, this does not include owner-occupied property, as that is not an income-generating investment. A real estate is an investment tool that has made many people rich. One of the reasons why real estate will continue to be an important investment vehicle is population growth, and shelter is a basic necessity of life. For instance, the world's population was at around 6.1 billion in 2000 and increased by about 25% to about 7.6 billion in 2019, and it's projected to hit about 9.8 billion by 2050. There are different categories of real estate investment. This includes land, offices, residential, retail properties, industrial properties, hotels and so on. So, one classic example is the residential dwellings. To generate monthly rental income, the property could be either acquired through a mortgage or purchase the property outrightly. If it's an outright purchase, it is a matter of estimating how long it will take to recover the initial capital invested. On the other hand, if investors take out debt in form of a mortgage to buy a property, this allows them to buy a property even if they do not have the total amount. Then, they can use the rental income to pay down their loan and build up their equity in the process. For instance, if the property costs $250,000 and you have 20 years to pay back, this means that you have a mortgage payment of $1,042 per month excluding interest and taxes, and your monthly rental income is $3,500. This implies that tenants are paying for your mortgage and at the same time you are making an extra income. In addition, the property value tends to grow over time, and over a long time the property can be sold at a much higher price than its purchaser's price. 2. Real Estate Investment Trust (REITs). Real Estate Investment Trust (REITs) are investments through public markets. REITs are companies that mainly own, and in most cases operate, income-producing real estate. For investors that want to invest in real estate but do not want to deal with all the management and logistics of owning a real estate property, then a REIT can be a good option for those investors. Investing in REITs can be likened to investing in a company as a shareholder. So, investing in REITs means you are investing in a company that owns and operates a real estate business where investors can buy shares and receive dividends. This company deals with the operation, management and logistics involved in the properties, collects the cash flow generated from the properties and distributes their earnings as dividends. REITs are traded on exchanges such as the National Association of Securities Dealers Automated Quotation System (NASDAQ). 3. Stocks. Buying a particular company's stocks makes you a part owner of the company, and in turn, you benefit from the growth and profitability of the company. For instance, if a company worth $100 million and issues 10 million shares and you own 500,000 shares, it implies you own 5% of this company. In other words, you own $5 million worth of this company. There are two main ways people get rich using stocks. First is value growth. So, if the company you own stocks in increases in value, for example, from $100 million to $200 million, then the value of your 5% ownership also increases from $5 million to $10 million. Another example, the company Amazon was worth around $81 billion at the end of 2010, and about 10 years after, in April 2020, the company is worth around $1 trillion. That is about 1,135% growth, which implies that if you had invested $10,000 in 2010, your investment would be worth around $113,500 as of April of 2020. The second way to make money using stocks is through dividends. Many companies distribute part of the profits as dividends to their shareholders, and investors receives dividend on top of their investment growth. Investors can either spend the dividend they receive or reinvest to buying more stocks, allowing them to compound their earnings even further. This is an investment that people use as part of their get-rich strategy. 4. Bonds. A bond is a debt instrument. It is a loan made by an investor, individual or institutional investors, to a borrower, companies or government. If a company or a government needs to raise capital to finance a project, they do so by raising capital externally, and it's usually through the financial markets. They, therefore, issue securities generally called debt securities or bonds, then the investors, bondholders, buy the bonds with a pre-specified maturity date and at a coupon rate, so, at maturity, the investor get back the par value, principal amount, plus the coupon payment. The advantage of being a bondholder is that a bond is a debt that a company has to pay back even in the case of losing market value. That is why it is a low-risk investment compared to stocks, and the return on investment is equally low, usually at an average rate of 3% per annum. Therefore, most investors use bonds to diversify their investment portfolios and minimize their total risk. 5. Index funds. Index funds are mutual fund types with a portfolio that tracks the performance of a section of the financial market, like the Standard & Poor's 500 index, S&P 500, that is, the 500 biggest companies in the US. This is to say it has a broad market exposure, which implies the risk is minimal compared to buying a company's stock. In addition, index funds have a low operating expense such as transaction fees, payment to advisors and managers, and accounting fees. 6. Digital products. Digital products are an intangible product that you can't feel or touch and exist in digital form. Examples include e-books, software, and so on. Digital products are fast becoming a massive asset for businesses and individuals, to the extent that celebrity like Damon John, for example, he's getting into the digital information business because of its potential to keep earning income as a digital product is created once and profit keeps flowing day in and day out. 7. Patents and trademarks. A patent is a form of intellectual property that provides an individual the legal right to restrict other people from making, using, selling, or importing its invention, while a trademark is another form of intellectual property that helps to differentiate a product or service to others, through its design or signs such as logos and names. If you have an invention that you think it's potentially lucrative, you can file for a patent to protect your invention, and companies will have to pay you to use your inventions. It could be an idea of a product or software. If your invention has a marketable value, you can license your patent to companies and make residual income from it. For instance, have you ever heard of Slinky? This simple invention was accidentally made by Richard James and has made around $3 billion in profits. Same with the Furby, an electronic robotic toy that was released in 1998. This little patented idea made around $500 million per year at its peak. 8. Copyright. Copyright is the exclusive legal right granted to an individual who has created an original work of art, such as books, music, poetry, among others, to reproduce, sell or license, publish or perform the work. Therefore, any work of art or creative work is a great asset, as it can also be licensed out for royalty. A typical example is J.K. Rowling, the author of the popular book series of 7 Harry Potter novels, who made serious money from the royalty from the novels as well as the movie series. This video is for information purposes and not a financial advice. Always do your research and/or consult with a financial advisor before making investments. Consider to subscribe so you can get more videos on valuable topics such as personal development, building wealth, financial education, and so on. Also, turn on the notifications so that you can be notified when a new video is uploaded. If you enjoy the video, like it and share it. Check in the description below for recommend books on investment and personal finance. Thanks for watching.